In the intricate and often bewildering tapestry of global finance, cultivating a profound understanding of the true nature of interest rates is far more than a mere academic exercise. It represents the absolute cornerstone of informed, strategic decision-making for every astute trader, discerning investor, and meticulous financial analyst operating within these complex markets. At the very heart of this profound and indispensable understanding lies the groundbreaking work of Irving Fisher, a luminary whose intellectual contributions continue, with remarkable precision and enduring relevance, to shape how we fundamentally perceive the intrinsic value of money as it inexorably traverses the dimension of time. Fisher, an eminent American economist, statistician, and mathematician, stood as an intellectual titan, unequivocally recognized as one of the most influential neoclassical economists of his era. His pioneering scholarship meticulously laid the foundational principles for modern financial markets through his profound and widely cited contributions to the theory of capital, the intricate mechanics of monetary theory, and the rigorous data-driven discipline of econometrics. Born in 1867, Fisher's academic career at Yale University spanned decades, marked by an insatiable curiosity and a relentless pursuit of economic truth, often employing mathematical rigor previously unseen in the field. His enduring legacy offers an exceptionally powerful and analytically robust lens through which to decipher the intricate, often counterintuitive and perpetually dynamic forces that govern borrowing and lending, saving and investing in contemporary economies. This comprehensive video will systematically delve into Fisher's revolutionary theory of impatience and opportunities, and more importantly, meticulously unveil 4 strategic approaches directly derived from his pioneering theoretical framework, each absolutely essential for anyone seeking to cultivate a deeper, more robust, and ultimately more profitable command of interest rate analysis in today's volatile and interconnected economic landscape. Irving Fisher's indelible impact on economic thought and financial practice cannot be overstated. Indeed, his contributions form an indispensable part of the intellectual bedrock upon which the entire edifice of modern finance is meticulously constructed. He was, notably, the first economist to meticulously and unequivocally differentiate between real and nominal interest rates, a conceptual distinction so fundamental to contemporary financial analysis that it is now often taken for granted, its revolutionary origins sometimes forgotten. This single insight alone, revolutionary in its time, provided a clarity and precision that was previously sorely lacking in economic discourse, transforming how economists and practitioners understood the true cost of money. His seminal work, The Theory of Interest, published in 1930, stands as a monumental and enduring synthesis of decades of his relentless and rigorous research into the multifaceted nature of capital, the intricate processes of capital budgeting within firms and economies, and the myriad factors, both apparent and subtle, that coalesce to determine interest rates. Crucially, his work explicitly and rigorously incorporated the pervasive and often corrosive influence of inflation, a factor frequently overlooked, poorly understood, or inadequately integrated into economic models before his incisive analysis. The publication of this magnum opus, coming as it did on the very cusp of the Great Depression, lent it an even greater urgency and profound relevance as the world grappled with unprecedented economic turmoil and the desperate need for sound. Empirically grounded financial theory was acutely and universally felt. Contemporary economic models concerning the behavior of interest rates and the valuation of capital, from the most basic undergraduate texts to the most sophisticated quantitative frameworks employed by hedge funds and central banks on Wall Street and beyond, owe an immense and universally acknowledged debt to the foundational principles established by Fisher. He transcended the simplistic, often superficial view of interest merely as a rudimentary cost of borrowing or a straightforward return on investment. Instead, he conceptualized interest as a far more profound phenomenon, an index of society's preference for $1 of current income over $1 of future income. This profound perspective, rooted in behavioral insights long before behavioral economics became a distinct field, underpins his comprehensive theory of interest, which he famously dubbed the theory of impatience and opportunities. According to Fisher, interest rates are not arbitrary figures imposed by authority or random market whims. Rather, they emerge dynamically and organically from the intricate and continuous interplay of two primary, often subtly opposing forces. The first is the inherent time preference, which he also referred to with striking psychological insight as impatience, that individuals and collective societies exhibit for capital that is immediately available now, rather than deferred to a later, potentially uncertain date. The second is the objective and quantifiable principle of investment opportunities, which dictates the potential for capital to grow and generate returns when deployed productively within the economy. This comprehensive theory provides an exceptionally robust, psychologically astute, and empirically testable explanation for the universal human tendency to prefer present consumption over future consumption, a deeply ingrained preference that, as Fisher meticulously demonstrated, dictates the very structure and behavior of financial markets, influencing everything from individual savings habits and household debt levels to national investment policies and international capital flows. Fisher's ability to unify these seemingly disparate subjective and objective elements into a coherent, powerful framework remains one of his most significant intellectual achievements, offering a timeless lens through which to analyze financial phenomena. The first crucial strategy, directly derived from Fisher's unparalleled analytical framework and indispensable for any serious financial practitioner, involves the absolutely critical distinction between nominal and real interest rates, a concept so pivotal that it is elegantly and compactly encapsulated in his eponymous Fisher equation. The nominal interest rate, often symbolically denoted as I, is precisely what its name implies: the stated, advertised, or explicitly quoted rate that we directly observe in the financial marketplace. This is the rate banks publish for savings accounts, the coupon rate on a corporate or government bond, or the interest rate advertised for a personal loan, mortgage, or credit card. It represents the raw, unadjusted figure, the face value of the interest payment. In stark and critical contrast, the real interest rate, typically denoted as R, is the nominal rate meticulously adjusted to rigorously account for the pervasive and often insidious effects of inflation. This adjustment is far from a mere technicality. It is, in fact, absolutely fundamental, because the real interest rate represents the true underlying economic cost of borrowing, or, conversely, the genuine inflation-adjusted return on an investment. It provides an accurate and unvarnished reflection of the actual change in purchasing power over a given period, revealing whether your money has truly grown in value or merely kept pace with, or fallen behind, rising prices. Failing to grasp this critical difference leads to significant and often costly miscalculations in evaluating investment opportunities, inaccurately assessing the true cost of capital for businesses undertaking long-term projects, and fundamentally misunderstanding the time value of money, which is the bedrock principle of all financial valuation and capital allocation. Historically, before Fisher's clear articulation, economic analysis often conflated these two rates, leading to policy errors and misinformed investment decisions, particularly during periods of high inflation. Fisher's equation precisely and elegantly formalizes this critical relationship. 1 plus I equals 1 plus R times 1 plus pi, where pi rigorously represents the expected rate of inflation over the investment horizon. This multiplicative form highlights the compounding effect of inflation. For practical applications in everyday financial scenarios, particularly when expected inflation rates are relatively low to moderate, this precise equation can be simplified to a more intuitive and readily applicable linear form. I approximately equals R plus PI. This simplified version, while an approximation, still conveys the core relationship with immense clarity and serves as a powerful mental model for quick calculations. Let's consider a practical and highly relevant example to powerfully illustrate its profound significance for financial decision-making, particularly for an investor. Imagine a scenario where a corporate bond offers a nominal interest rate of 10%, presenting an apparently attractive headline yield. However, if the expected inflation rate over the same maturity period is a significant 6%, then a quick application of Fisher's simplified formula reveals that the real interest rate, or the real return on that bond, is only approximately 4%. This means that while your initial investment has nominally grown by 10%, its actual purchasing power, its ability to buy goods and services in the future, has effectively only increased by 4%. For a trader managing a fixed income portfolio, this insight is crucial for understanding the real value of their holdings and hedging against inflation risk. For an investor planning for retirement, it highlights the importance of seeking investments that offer a real return above inflation to maintain living standards. This is an absolutely crucial insight for any investor, as it delineates the fundamental difference between apparent nominal gains and genuine wealth creation. This fundamental concept also naturally leads us to the Fisher effect, a robust empirical observation and a powerful theoretical proposition that describes the consistent tendency for nominal interest rates to adjust, often quite rapidly and efficiently, in tandem with changes in the expected rate of inflation. The underlying Fisher hypothesis posits, with considerable empirical backing across diverse economic cycles, that the real interest rate is largely determined by fundamental long-term economic factors such as productivity growth, technological innovation, and societal thrift, and is therefore relatively independent of short-term fluctuations in monetary policy. Consequently, nominal interest rates are posited to naturally and efficiently adjust to incorporate shifts in anticipated inflation, ensuring that the real return to lenders and the real cost to borrowers remain stable over time, at least in the long run. For active investors and astute traders, grasping this powerful effect is absolutely vital for accurately forecasting how prevailing inflation expectations will reverberate through and impact the profitability of various asset classes. This includes fixed income securities, such as government bonds or corporate debt, where inflation directly corrodes real returns but also extends to equities, real estate, and commodities, where inflation can have complex and varied effects, sometimes acting as a tailwind, sometimes as a headwind. Understanding the Fisher effect allows for the development of more informed hedging strategies against inflation risk, such as investing in Treasury inflation-protected securities, TIPS, which are explicitly designed to offer a real return and enables sophisticated portfolio adjustments designed to preserve and grow real capital in an inflationary environment. For central banks, the Fisher effect is a cornerstone in understanding the transmission mechanism of monetary policy and how their actions, such as setting benchmark interest rates, influence market rates and shape public and market inflation expectations. Accurately estimating expected inflation, however, remains a significant challenge, often relying on surveys, inflation-indexed bond yields, and econometric models, each with its own limitations, adding a layer of complexity to the practical application of Fisher's elegant framework. Moving beyond the purely quantitative realm, the second strategic pillar in Fisher's comprehensive and psychologically insightful framework zeroes in on a profoundly subjective yet immensely powerful factor that Fisher termed impatience, or what is more formally and academically known as subjective time preference. At its conceptual core, the theory of impatience posits a fundamental truth about human economic behavior. Individuals, almost universally and consistently across cultures, tend to prefer receiving goods and services today rather than deferring their gratification to some uncertain point in the future. This deeply ingrained psychological preference is not a peripheral consideration in economic models. It is, in fact, a fundamental bedrock determinant in the dynamic formation of interest rates across all financial markets. The precise degree of this impatience is a direct and measurable reflection of an individual's utility function, representing the personal and often unconscious trade-off they are willing to make between the immediate gratification of current consumption and the potential, but deferred, benefits of future consumption. It is a powerful psychological driver that subtly yet profoundly shapes economic decisions at every conceivable level, from a household's decision to save for retirement or take out a loan for a new car, to a multinational corporation's choice between paying dividends to shareholders and reinvesting profits into long-term growth projects. This concept is closely related to modern behavioral economics, particularly ideas like hyperbolic discounting, where the perceived value of future rewards diminishes more sharply as they recede into the distance. A multitude of complex and interconnected factors can significantly influence the degree of an individual's or indeed a collective society's impatience. For instance, the sheer size and, critically, the stability of one's income play an immensely crucial role. Individuals blessed with larger, more predictable and stable streams of income may, logically, exhibit less impatience. They are often more willing and able to defer gratification, secure in the knowledge that their future needs and desires are likely to be comfortably met without immediate sacrifice. Conversely, those grappling with precarious, limited, or highly uncertain incomes might display a markedly higher degree of impatience, understandably prioritizing immediate needs and present survival over distant future prospects that may never materialize. This is why, for example, payday loans, despite exorbitant interest rates, find a market among those with high present bias. The specific composition of income also matters significantly. Whether an individual's income is primarily derived from stable, long-term wages, highly volatile investment returns, or unpredictable entrepreneurial ventures can profoundly alter their underlying time preference and their willingness to save or borrow. Furthermore, the pervasive and often anxiety-inducing factor of uncertainty or probability plays an absolutely significant role. Future incomes, by their very nature, are invariably subject to a degree of uncertainty, whether this stems from broader economic fluctuations, unforeseen personal circumstances, or sudden, unpredictable shifts in broader market risks. This inherent unpredictability, this shadow of the unknown, can powerfully amplify the preference for current consumption, as a guaranteed present benefit is almost invariably favored over a future benefit that remains to some extent speculative and contingent. Lastly, individual psychological traits and cognitive abilities, such as inherent foresight, personal discipline, and the capacity for accurate long-term forecasting, also contribute significantly to the observed differences in impatience among individuals. Those endowed with a strong ability to plan meticulously and foresee future needs, and who possess the discipline to act on these insights, might naturally be less impulsive and more inclined towards saving and long-term investment. In contrast, others may struggle considerably with long-term planning and self-control, leading to a higher preference for immediate gratification and a greater reliance on credit. Societal factors also play a role. Robust social safety nets, universal health care, and stable political environments can reduce collective uncertainty and consequently lower societal impatience, encouraging long-term investment. Conversely, societies facing political instability or economic insecurity tend to exhibit higher collective impatience. For financial professionals, cultivating a deep understanding of these complex, deep-seated psychological drivers that underpin saving and investment decisions is not merely an academic exercise. It is an indispensable tool for understanding market sentiment, predicting consumer behavior, and designing financial products. It allows for a far more nuanced, empathetic, and ultimately accurate interpretation of market behavior, consumer spending patterns, and the collective appetite for risk, deferred rewards, and the allocation of capital across time. Recognizing these human elements can provide a distinct edge in predicting market trends, understanding investor sentiment, and even anticipating shifts in monetary policy that respond to consumer confidence and spending. The third strategic pillar within Fisher's remarkably robust framework shifts our focus from the subjective realm of human psychology to the objective and quantifiable dimension, the meticulous evaluation of investment opportunities. Interest rates, Fisher contended, are not solely a product of intrinsic human psychological tendencies. They are equally and powerfully shaped by an objective and undeniable economic principle: the inherent and demonstrable ability to invest current income today in order to generate a greater, enhanced income in the future. This objective factor directly and unequivocally reflects the fundamental productivity of capital itself, as well as the potential returns that can be generated from deploying capital across a vast spectrum of diverse investment avenues. This principle is often referred to as the marginal efficiency of capital, or the rate of return over cost. There exists an intrinsic, almost symbiotic relationship between the availability and attractiveness of investment opportunities and the underlying productivity of capital. The higher the potential productivity or the expected rate of return on a given investment, be it a new factory, a groundbreaking research project, or an expansion into a new market, the stronger the motivation, both for individual entrepreneurs and for vast corporate entities, to consciously forego immediate current consumption in favor of pursuing that future, potentially much larger, growth. Fisher himself, with characteristic breadth of vision and analytical precision, defined capital broadly as any asset, tangible or intangible, that is capable of generating a predictable or even an unpredictable stream of income over a sustained period of time. This expansive definition includes not only physical capital like machinery and buildings, but also human capital, education, skills, natural capital, land, resources, and intellectual capital, patents, software. He profoundly emphasized that the intrinsic value of such capital is not merely its present cost, but is fundamentally derived from the carefully calculated, discounted present value of all these anticipated future incomes. This crucial understanding underpins why businesses, from nascent startups seeking venture capital to multinational behemoths investing billions, consistently choose to invest colossal sums in new machinery, cutting-edge technology, extensive research and development projects, or ambitious expansion initiatives. They do so not out of blind faith, but because they meticulously anticipate that the future returns and increased income streams generated by these investments will demonstrably outweigh the immediate costs incurred and the immediate consumption or dividends deferred. The impact of the prevailing landscape of investment opportunities on interest rates is both direct and profoundly significant. Periods characterized by robust, abundant, and highly attractive investment opportunities, often spurred by transformative technological advancements like the Internet revolution or artificial intelligence, waves of innovation in sectors like biotechnology, or extended periods of significant economic expansion and globalization, tend to dramatically increase the aggregate demand for capital across the economy. This heightened demand for funds necessary to finance these productive endeavors, in turn, can exert strong upward pressure on real interest rates, as investors, entrepreneurs, and corporations actively compete for available capital to finance and capitalize on these lucrative prospects. This competition drives up the price of capital, which is precisely the interest rate. Conversely, in periods marked by a scarcity of productive or compelling investment opportunities, perhaps during an economic downturn, a period of technological stagnation, or due to adverse government policies, there might be a lower aggregate demand for capital. This reduced demand can, consequently, lead to a downward pressure on real interest rates, reflecting the diminished need for borrowing to finance less attractive projects. Government policies such as tax incentives for R&D, infrastructure spending, or deregulation can significantly influence the perceived attractiveness and profitability of investment opportunities, thereby indirectly impacting interest rates. Global capital flows also respond to these differences, with capital moving to regions offering higher expected real returns. Therefore, changes in the dynamic landscape of investment opportunities serve as an absolutely critical influence on the long-term trajectory and short-term fluctuations of real interest rates, providing a powerful and often leading indicator for market analysts attempting to gauge future economic activity, assess corporate earnings potential, and anticipate monetary policy responses. Understanding this objective principle allows investors to strategically align their capital allocation with sectors, industries, and geographic regions demonstrating high capital productivity and promising growth prospects. The fourth and final strategic pillar within Fisher's masterful and enduring framework involves the sophisticated synthesis of these previously discussed subjective and objective factors, and their practical application to achieve a comprehensive, holistic understanding of the complex dynamics that govern interest rates. Fisher's true genius lies in his elegant and intuitive demonstration of how the equilibrium interest rate, the rate at which the market for loanable funds clears, where the amount people want to save equals the amount people want to invest, is ultimately determined by the precise intersection of these two fundamental forces. On one side, we have the curve representing time preference, which essentially depicts the aggregate supply of savings within an economy. This upward sloping curve illustrates how much individuals and institutions are willing to save at various interest rates, reflecting their collective impatience or willingness to defer consumption. As interest rates rise, the reward for saving increases, making people more willing to postpone current consumption. On the other side, we have the curve representing investment opportunities, which conversely illustrates the aggregate demand for capital within that economy. This downward sloping curve shows how much capital businesses and entrepreneurs are willing to borrow and invest at different interest rates based on the expected productivity and returns of available projects. As interest rates fall, more projects become profitable, increasing the demand for capital. This intricate and continuous interaction between the supply of savings, driven by impatience, and the demand for capital, driven by investment opportunities, precisely dictates how much a society, as a whole, is willing to save and, concurrently, how much it is prepared to invest. When the collective desire for current consumption, that is, impatience, is high, individuals save less at any given interest rate, shifting the supply curve of savings to the left and potentially pushing equilibrium interest rates upwards, as borrowers must offer more to attract scarce savings. Conversely, when profitable investment opportunities abound, the demand for capital rises, shifting the demand curve to the right and also influencing rates, as increased competition for funds bids up the interest rate. The point where these two powerful forces meticulously balance defines the prevailing equilibrium interest rate in a given economy. For financial professionals, whether they are high-frequency traders analyzing yield curve movements, long-term portfolio managers constructing diversified portfolios, or macroeconomic analysts formulating policy recommendations, these insights translate into highly practical and actionable conclusions that can significantly enhance decision-making and provide a distinct competitive advantage. For instance, in the challenging realm of forecasting interest rates, a truly holistic and accurate approach necessitates diligent and continuous analysis of not only anticipated inflation rates, which are often volatile, but also nuanced shifts in the collective time preferences of consumers, e.g., demographic changes, cultural shifts towards immediate gratification, and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing, often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the prevailing often rapidly changing investment climate, e.g., and the technological breakthroughs, new market opportunities, regulatory changes, understanding the deep psychological underpinnings of saving behavior alongside the technological, demographic, and economic drivers of capital demand, provides a far richer, more robust, and ultimately more accurate predictive model than simply relying on historical data or isolated economic indicators. For traders, this means interpreting yield curve movements not just as a reflection of monetary policy, but as a dynamic interplay of these fundamental forces, allowing for more precise bets on future rate directions. In the critical domain of managing financial risks, Fisher's framework is absolutely indispensable for accurately evaluating the real profitability and actual risk-adjusted returns of investments. This requires meticulously adjusting for the insidious and often underestimated effects of inflation, and rigorously scrutinizing the inherent risks and uncertainties inextricably linked with the future incomes that any investment promises. This disciplined approach ensures that investment and risk management decisions are grounded in genuine wealth creation and preservation, rather than being misled by illusory nominal gains that simply keep pace with inflation. For a portfolio manager, this means constructing a portfolio that hedges against real rate fluctuations, perhaps by diversifying across assets that perform differently in various inflation
regimes. Furthermore, in making critical long-term investment decisions, Fisher's method compels individuals and institutions to thoughtfully and strategically weigh the fundamental trade-offs between immediate consumption, with its fleeting gratification, and strategic investments that are meticulously designed to maximize long-term future utility and wealth.
It is fundamentally about optimizing the intertemporal allocation of capital to achieve enduring financial goals, aligning present actions with future aspirations for sustainable growth. The modern relevance and enduring power of Fisher's method cannot be overstated. Indeed, it remains as pertinent today as it was nearly a century ago, even amidst the complexities of contemporary global finance. His foundational principles remain absolutely central to contemporary macroeconomics and, crucially, to the sophisticated formulation and execution of monetary policy by central banks across the globe. The clear distinction between nominal and real rates, for example, is a cornerstone for central bankers as they calibrate policy interest rates to precisely influence economic activity, manage inflationary pressures, and steer the economy towards stability and growth, often targeting a specific real interest rate. Moreover, Fisher's elegant framework finds extensive and sophisticated application in modern models for asset valuation, particularly for long-term assets like real estate, infrastructure, and growth stocks, where the time horizon is extended and future cash flows are paramount. It is also invaluable in the meticulous analysis of complex debt markets, where the interplay of the time value of money, inflation expectations, and real yields is absolutely paramount for pricing, risk assessment, and the design of financial instruments. Even in the era of zero lower bound interest rates, quantitative easing, and the emergence of digital currencies, Fisher's core insights into time preference and capital productivity continue to provide a robust analytical foundation for understanding the underlying forces at play, demonstrating the timelessness of his economic wisdom. In summary, Irving Fisher's pioneering method provides a comprehensive, profoundly insightful, and enduring toolkit for understanding the intricate dynamics of interest rates. It transcends a mere numerical interpretation, inviting us instead to view them as the intricate and often delicate outcome of a complex interplay between subjective human preferences, our collective impatience, and the objective realities of economic opportunities. By diligently and systematically applying these four strategic approaches, meticulously distinguishing nominal from real rates, incisively analyzing the factor of impatience, objectively evaluating the landscape of investment opportunities, and skillfully synthesizing these subjective and objective forces, traders, investors, and financial analysts can cultivate a far more nuanced, robust, and ultimately more profitable understanding of financial markets. This mastery allows for the adoption of more informed, more strategic, and more resilient decisions, accurately assessing the true cost and value of money across time, and adeptly navigating the pervasive and often unpredictable influence of inflation on wealth accumulation and investment returns. It is this depth of understanding, this ability to see beyond the surface numbers into the fundamental drivers of economic value and human behavior, that truly distinguishes successful market participants from those who merely react to events. To truly excel in the dynamic and ever-evolving world of finance, one must not only grasp the theoretical underpinnings and analytical frameworks that govern markets, but also appreciate the rich historical context that has profoundly shaped our financial world into what it is today. The markets of today are not isolated phenomena, disconnected from the past. They are, in many profound ways, echoes of historical cycles, filled with intricate stories of triumphs and tribulations, of brilliant strategies executed with precision, and of devastating blunders born from hubris or miscalculation. To gain an unparalleled, deeply textured perspective on these historical currents, to truly understand the foundational events and the legendary titans who shaped the very fabric of Wall Street over a pivotal and transformative half-century, we wholeheartedly recommend exploring 50 Years in Wall Street. This monumental and beautifully illustrated two-volume work by Henry Clews offers far more than just a chronological chronicle. It is an immersive, insider's journey through a crucial period of financial history, meticulously covering everything from the tumultuous panic of 1857 right into the heart of America's opulent yet often ruthless Gilded Age. Within its pages you will discover unique, often surprising and deeply personal first-hand accounts of legendary financiers, gain an intimate understanding of the intricate mechanics of historical market manipulations, and absorb invaluable insider insights into the pivotal economic and political events that defined an entire era of American capitalism. It's an absolutely invaluable resource for any serious investor, dedicated trader, or discerning analyst seeking to profoundly deepen their understanding of market psychology, to recognize and anticipate cyclical patterns, and to grasp the enduring, timeless principles of finance, all presented through the vivid and compelling lens of those who personally lived through, shaped, and were shaped by these momentous times. To profoundly enrich your financial library, to cultivate a truly unique historical perspective that informs present-day decisions, and to learn directly from the wisdom and follies of financial giants, find the direct link to 50 Years in Wall Street, conveniently placed in the description below this video. Mastering Fisher's strategies, complemented by a deep appreciation for financial history, empowers you not just to react to market shifts, but to anticipate them, building a resilient, adaptive, and ultimately more profitable approach to all your financial endeavors.